Welcome to Metrostudy's quarterly housing webcast. My name is Justin Caron, Metrostudy's Vice President of Membership Services. I'll be moderating today's session. Our Chief Economist, Mark Boud, will present a national State of the Union on the current residential construction market, answering a number of critical questions, including where are we in the housing cycle, what are the trends and forecasts for housing starts, closings, and other key indices, are international issues slowing the U.S. economy, and of course, what's in store for 2017. We will then shift to a few of our regional experts, Mr. John Covert, Eric Allen, and Todd Britsch, who will provide a granular view of Denver, Salt Lake City, Portland, and Seattle. They will share where their markets are in the cycle and how builders in their markets are responding to pressure and capitalizing on opportunity. At the conclusion of the regional conversations, we will open the floor for a dedicated Q&A with all of our experts, time permitting. As we move through these presentations, please note, track, and/or submit your questions for this Q&A session. In the essence of time and due to the sheer size of our audience today, you are able to send these questions to me via the chat window during the presentations, and I'll be asking the questions on your behalf. All of your lines will be muted during this session, and if email is easier, you can send them directly to me at jcaron@metrostudy.com. With that, I'll turn the virtual podium over to Mark Boud to kick us off.
Thank you, Justin, and good morning. This is Mark Boud. I am recording from the Southern California office of Metrostudy and grateful to join you all. There's over 500 of you joining us this morning. That's exciting to us. What we have to share with you this morning is exciting in terms of describing not only the past and present housing cycle, but what we think it looks like for the next 5 years. Many of you will be very excited about the information that we share with you. It's all associated with our publication called the Residential Economic Report, and that report is available in the top 100 markets throughout the nation. So if you like what you see with regard to the national platform that we're presenting, just contact your local Metrostudy representative, and they're happy to share with you the local forecast in the same format. Let me actually start with employment. During the past 12 months, we've created over 2.4 million jobs in the United States on a 12-month rolling basis. That's a little bit slower than what it has been during the past few quarters, and you would expect that given the uncertainty associated with an election year. We do expect employment to actually improve during the latter part of this year once the election is settled, and we expect first quarter 2017 to be rather strong as well. In terms of the types of jobs being created, we see a lot of jobs being created in terms of professional and business services, as well as health, educational services. We're seeing strong growth in leisure and hospitality and transportation, trade, and utilities. Part of that is due to the very low gasoline prices that continue throughout the nation. What that does is it puts more discretionary income in consumers' pockets. Last year, we saved a lot of that. We used some of that to pay off debt. This year, we're spending more. We think that next year we spend even more. Construction has picked up quite a bit, though it's still not the main driver in this particular cycle. We think that's a good thing. It was the main driver in the past cycle, and it contributed to a downfall once construction jobs went away very quickly. Not so in this case. We see positive public sector or government jobs. That was actually negative about a year ago, and the fact that it's contributing to the economy now is a positive thing. We see losses in manufacturing and natural resources, mainly due to the losses that we're seeing in the oil production industry. Let me actually share with you where we are in terms of unemployment. The official unemployment rate is now below 5%. It's been hovering for the past few months at 4.9%. We actually think after the election, it will trend downward further. Same thing with the U6 unemployment rate. It's hovering around 9.7%. We actually expect that to trend down further once questions are resolved in terms of the election. The overall initial unemployment claims continues a downward trend, which is healthy. Let me share with you information with regard to population by generation, kind of focusing on the millennials, which everyone is talking about. What these bars show is the blue bar is the year 2000 census share of millennials of the entire population. The yellow is 2010, orange is 2016 estimate, and green is our 2021 forecast. You can see that the baby boomer generation is losing its influence, though it's still very high and is expected to remain high during the next 5 years. It's just waning in terms of its overall impact. Not so with millennials. We think that despite the fact that the population remains the share of the population of millennials remains somewhat static during the next 25 years, we expect their influence to grow as more of them exit the rental market and enter into the forced sale market. First-time homes, the first few tiers of move-up homes, should be increasingly popular. We as an industry haven't done a good job in terms of supplying the number of homes that's demanded in those lower price ranges. We hope we can improve that as time goes on. Overall household incomes, we expect them to increase at a fairly healthy rate during the next 5 years. They've been flat, even negative during the recessionary years. We think that changes. We'll be creating a lot of households that are making above $75,000 during the next 5 years. And that's partly due to the tightness that we're feeling in the labor market that it's finally beginning to push up wages and salaries and incomes. Here's the overall relationship between unemployment and consumer confidence. You can see as the unemployment levels have fallen, consumer confidence has increased. We actually felt a fairly decent increase during the past month, a little surprising given it's the election season. We expect this to actually continue upwards during fourth quarter and into first quarter of next year. Mortgage rates, they're at 3.46, one of the lowest recorded rates that we've seen in terms of fixed 30-year rates. We expect them to remain low for just a couple months more. By December of this year, we actually expect them to experience a slight increase, and that gradual increase will continue during the next 5 years. We think that the economy is sufficiently strong to begin to push those rates up. Keep in mind that mortgage rates tend to be a lagging indicator, and what they lag is economic growth, and by definition, economic growth is fueling housing demand. So interest rates are a lagging indicator, and as they go up, we do have weapons or tools to combat those higher fixed rates. They're called ARMs. We're hardly using them at all now. We'll use them increasingly as the rates increase. This is our forecast in terms of overall housing starts. You can see the starts from year 2000 forward. This is our estimate for next year. 2017 is 1.265 million. By 2018, we'll hit 1.353 million. That's high. It's improving, but it's nowhere close to the peak that we experienced in 2005, where almost 2.1 million starts occurred that year. Most of that, not most of it, but a lot of that was artificial, originating from a lot of speculation that was occurring in 2004, 2005, 2006, and it fell hard. We're actually climbing out of that at a very slow rate. We could absorb homes at a faster rate, but the construction industry is facing challenges which are really preventing that ramp up in supply at a faster rate. Here's the overall sales patterns that we're experiencing in terms of new housing sales. Our forecast next year is 638,000 new homes being sold. In 2018, it's 708,000, a gradual trend upward. Even by the end of 2018, though, look how far below were the peak year of 2005, when we sold 1.279 million. Again, a lot of that was artificial. We won't repeat that in the current cycle. This cycle tends to be far more solid, despite the fact that it's not nearly as exciting as last time. It's solid. It's built upon a solid foundation going forward, whereas last time it was largely a house of cards. I wanted to share with you the overall supply of new homes. Right now it's about 11%, which is relatively low. The overall long-term average kind of bumps between 14 and 15%. It got as high as 16 to 17% in 2005. It got as low as 9% in 2010. So we're increasing it, but we're nowhere near the long-term norm, and we expect that to continue to normalize during the next few years. This chart shows the overall patterns in terms of price and affordability of the existing home market relative to the new home market. The shaded area here shows the existing home market price line. You can see it bumped up fairly significantly during the past couple of quarters. New homes increased as well, but not at the rate, and that spread between existing homes and new homes actually narrowed a bit, though it's still quite a bit wider than it has been historically. Part of the reason we're seeing that new home premium is because of scarcity. We're not building enough new homes. It's also because the new home builders are somewhat being forced to build larger homes on smaller lot sizes because of very high land prices. It's partly due to technologies that are introduced into the new home market more easily than the existing home market. And it's partly due to where new homes are being built. More of them are being built in more expensive coastal markets on a relative basis than the existing market. In terms of consumer spending, you can see we experienced a pretty big jump during the past quarter in terms of what we're spending. A lot of that discretionary income, again, is being created by very low gasoline prices. We expect that to continue next year with very healthy consumer spending patterns that will likely keep the economy relatively strong during 2017. All of this information leads to this model that I referred to early on. Again, this model is available for the largest markets throughout the United States. I'll show you the national version, and if you're interested in the local version, simply contact your local Metrostudy representative. This is what the model shows in terms of the overall supply of housing relative to demand of housing. The blue curve is supply, the green curve is demand. The blue curve is built by lagged permit activity as it relates to census year. So every census year we benchmark the data, and our forecast for the next 5 years is actually built upon the physical count, lot count that Metrostudy does once a quarter. It gives us a very good idea as to what's in the pipeline and what's coming online. As far as I understand it, I think we're the only company that actually does that physical inventory, and it gives us a huge amount of accuracy in terms of understanding that supply curve going forward. The demand curve is a little bit more involved. It's based upon correlations of household formation with job formation by type and by magnitude, with interest rates, with construction patterns, with equity wealth, with the rollover of equity wealth associated with the sales patterns of existing homes, a few other things. But you can see it can actually go down, especially during times when we're losing jobs. The demand curve can have a negative slope to it. And you get these gaps between the demand and supply curve that describe whether the market is either undersupplied, as it is now, as it has been in past cycles, or oversupplied during recessionary years. And here's that ugly recession we just went through. This is where we are about right now. We expect undersupply to actually grow during the next couple of years. It'll plateau in 2018, 2019, before it begins to slowly recede in 21, 22. Despite the fact that it begins to recede, it remains undersupplied throughout a 5-year forecast, meaning that we should have stable to strong market conditions throughout the nation if this holds, and we think it will, but it does not account for those unforeseen circumstances that could occur that could disrupt this. Given the natural cyclical patterns that we've experienced in the past, this is what we think it looks like going forward. However, despite the fact that we'll be undersupplied during the next 5 years, that doesn't necessarily mean that all markets will do well. You can do poorly in an undersupplied market. You have to look at the overall spectrum of housing in a given market. For example, I'm working in a lot of markets where those markets tend to be a bit top-heavy, partly because the builders are being forced to build those larger homes on smaller lots. It's producing a lot of relatively expensive homes, and as the cycle matures, the chances of that band of housing, the upper end of the housing market, becoming oversupplied is much greater than the lower half of the market. So we'll increasingly see numbers of markets become relatively top-heavy, with absorption slowing down and price support beginning to crack in those upper price ranges, despite the fact that the overall market remains undersupplied. Affordability plays into that as well, and this is the other half of the model. What this side shows is the overall trends in median prices of housing, that's shown in blue, going forward. Here's that big bubble we created. Here's the trough of the recession. This is the high rate of appreciation we've experienced during the past few years. This is what we think happens during the next 5 years. We begin to approach a housing plateau and bump along a ceiling of overall pricing potential. That's what we think will happen and what actually has happened, that blue curve. The green curve is where we think prices should be based upon economic, socioeconomic, and demographic fundamentals. Mainly that relationship, that long-term relationship between household income and mortgage cost as it relates to that relationship right now. And basically what that's saying is that over time, as mortgage rates increase and as we continue to experience slight increases in price appreciation, affordability goes downward and it opens up this gap of oversupply. And the result of that is that prices have to form a plateau. We don't think they'll go down because there's a counterbalance of undersupply that keeps prices along this plateau, despite the fact that they're overvalued. But as we get closer to that ceiling, overall price appreciation has to slow. This is what the gap looks like between that those valuation curves, the price curve and the valuation curve that we showed earlier. Here's that big bubble of overvaluation that we experienced during the boom of the last cycle. Here's the amount of undervaluation that we experienced during the recession. Not many people could buy back then, but if they could buy in 2010, 2011, those who did buy were able to experience a windfall in terms of equity growth in ensuing years. This is where we are about now. We still think that we're undervalued on a national basis. However, as mortgage rates creep up, and again, we're forecasting that that first increase will be in December of this year, we think we'll go into another pattern of overvaluation. This will be far more natural and far more sustainable than what we experienced last time when it was an exorbitant bubble. I wouldn't call this a bubble as much as the natural fluctuation that we experience in the cyclical pattern of real estate. However, it is serious in that as we enter into this phase of overvaluation, obviously risk increases. It's easier to make a mistake. Despite the fact that we're undersupplied, you need to be aware that we will be overvalued and watch your pricing strategies very carefully. What that translates to is a reduction over time of the supportable rate of price appreciation going forward. So we've had some very healthy years. We think that over time, as we enter into the cycle of overvaluation, price appreciation has to begin to moderate quite a bit until it goes to about zero by the end of the 5-year forecast. It remains slightly positive. It doesn't go negative, but it certainly goes down in terms of its overall growth. How does this play in the new home market in 2016? Well, this is our heat map that shows the best markets shown in red down to orange, yellow, moderates, and then the cooler markets are shown in blue throughout the nation. This is 2016. Look what happens in 2017. You do get some markets that actually heat up a bit more. Those are a lot of the affordable markets, sometimes in the inland markets or in the southern markets. You also get some markets cooling off quite a bit, especially in this oil belt. You get some. If I were to redo this, I'd probably put Miami a little bit light blue. It's supported by a lot of international money, which is likely to continue to slow over time. This is how it impacts the remodeling markets. This is year 20. You can see those markets that are hot, as well as the markets that are a little bit cooler. Look what happens in 2017. Significant improvements in the coastal markets and kind of all over. There's still some coolness in some of those markets, but the overall trend is for dramatic increases in remodeling. And it doesn't mean that even this year, Florida certainly wasn't bad, California and Arizona certainly weren't bad. It's just that on a relative basis, they were a bit cooler than the Texas markets, which were on fire. Not so in 2017. Texas markets cooled down a bit, and the growth, the improvement kind of spreads throughout the nation. What that shows in terms of our forecast of remodeling activity, this is where we are right now. We've actually surpassed the previous high water marks in 2005, 2006. This is our forecast. We've actually had to revise this forecast upward a couple times this year as its strength continues, as discretionary income becomes more available, and as more of that income is funneled into home improvements, into remodeling projects. We expect the next 2 years to be especially healthy in the remodeling industry. So, to sum up, at least 2.5 million jobs being created, 1.27 million housing starts, 1.16 million closings, including multifamily. Next year, we'll experience slightly slower job growth throughout the year than we did 2016, but not much lower. It kind of remains par with this year. Part of the reason we'll experience a bit of a slowdown is because of international demand that's slowed a bit. And also, I'm still a little bit worried about public policy concerns. Mortgage rates will begin to gradually rise. We think that the first increase is the latter part of this year. By year 2017, the U.S. housing market will be undersupplied by 2.8 million homes. That's about 2% of the overall housing stock. We think also that next year we will begin to experience the beginnings of overvaluation in a lot of markets throughout the nation. And finally, remodeling and replacement activity will pick up significantly. It's already high. It's only going to get better during the next 24 months. The forecast increase during 2017 is 4.2%. We think that continues through year 2018. And with that, I'm going to turn the time over to our Denver office to look at that market.
Great. Thank you, Mark. Appreciate that. Welcome, everybody. I'm glad to see so many people joining us on the call this afternoon. Again, my name is John Covert. I'm the director for the Colorado region. I'm going to be focusing a little bit more specifically on the Denver metro area, which includes the Denver-Aurora MSA as well as the Boulder MSA, essentially the 7-county Denver metro area. We're going to get a little bit more granular about the new housing activity based on our lot-by-lot survey and some of the results of our most recent quarterly survey of the market. So you can see that the trend line when we look at annual starts and closings in the Denver metro area about halfway back to the peak of the previous cycle back in 2005 when we reached about 20,000 housing starts. So we're now at about 10,563 starts in the trailing 12 months. And if you pay particular attention to our third quarter starts alone at the top of the screen, about 2,895 starts in the third quarter. That's actually flat compared to the third quarter of 2015 when we started just a few units less. So this is something that we expected, particularly given that housing closings in the third quarter are up substantially, 23% increase over the third quarter of last year to about 2,601 closings. Starts in the second quarter, the previous quarter, were up substantially and closings were down. And this is in part because the significant backlog that builders have been facing in the Denver metro area over the last couple of years. And it's really come to a head during the summer of 2016, where trade labor was really at a significant shortage, placing a lot of pressure on builders getting homes completed and delivered. So we expected that starts would trail off a little bit in the third quarter, let the builders take a little bit of a breather and get caught up on completions and deliveries, and that's exactly what has happened. So overall, housing starts and closings are tracking about where we thought they were, and just for your information, this the data that we're looking at here includes all single-family detached townhome product, and condos are kind of rolled up all into these numbers. All right, so as Mark talked about, one of the constraints that we have in this market for additional growth going forward is that we're a little top-heavy in terms of where we're segmented by price for that starts activity. So you can see in this graph, all of our single-family starts in the third quarter of 16 have accelerated past third quarter of 15 annual starts figures for anything above a $400,000 base price. So in the market, in the Denver metro area now, anything that's priced above $400,000 represents about 67% of all of our starts. You can see about 27% of our starts are for product that's about $500,000 and greater. So anything over $400,000 is expanding over the year. Anything less than $400,000 in the market, you could see, has seen significant declines, and that's just in 1 year. And this is a trend that we've actually experienced over the last several years during this really rapid recovery that Denver has experienced. And it's something that we expect that's going to continue over the next year as wages increase and household income supports this kind of growth in the top parts of the market. What you'll notice that's also striking that everything under that $300,000 price point is virtually non-existent now. If you were to back up 10 years to the previous high of our last cycle, 2005 and 2006, when we started about 20,000 homes, about 50% of our housing production was priced under that $300,000 price point. Now it's 4%. So this is one of the constraints that we've got going forward, particularly for entry-level and first-time home buyers. Part of the reason why this rapid price increase here has taken place is because demand can support it. We've got a lot of move-up buyers that have moved into the marketplace. The resale market's incredibly healthy. We've got a lot of repaired equity in the market. Job growth has remained very robust here in Denver. Unemployment rates are near all-time lows. But secondarily, costs have risen so dramatically in the Denver market. Land costs, development costs, fees, and regulatory pressure, the materials costs, are all driving home prices up pretty dramatically here in Denver. So that's leaving a void and creating this unmet demand for first-time and entry-level buyers, particularly when you look at the average new home sales price in the market now is at an all-time high at $517,000 for the trailing 12 months. And this putting, again, a lot of pressure on first-time home buyers and entry-level buyers that have very few choices in the marketplace. Usually what has fulfilled that entry-level first-time home buyer demand, if we weren't able to accommodate it in the single-family sector of the market, generally those buyers would gravitate, historically in Denver anyway, to condos. You can see historically by this red line here, condos represented anywhere from 17 to 20% of all new home construction in the market. We peaked at about 26% back in the first part of 2008. And now during the recession and the subsequent recovery, that line has stayed relatively flat. So now representing about 3% of our home starts. And this is in part because Denver, like many markets around the country, are faced with construction defects, liability issues. So that's keeping many builders that had historically built condos in the market away from providing that segment that is so desperately needed today for first-time home buyers and entry-level buyers. So they're forced to go further out into the periphery to find homes, sort of back until you, or drive until you qualify mentality. So the other constraint that the Denver market's facing today, like many markets around the country, is lot supply. We generally consider the market to be in balance when we're around 2-year supply of finished lots. The gray bars represent the more production-sized lots, those lots that are roughly 7,000 square feet or less. You can see that over the last few years, we've really, lot deliveries have had quite a bit of difficulty of keeping up with the pace of absorption. So our lot supply now overall is 16 months for all the lots, both the big lots represented in the red bars and the smaller production lots represented in the gray bars, but 14-month supply of lots now for the smaller production lots. Just over a year supply. That's the tightest this market has ever been at a time when the market is absolutely trying to expand because demand is so robust here in Denver. So those are a couple of the major constraints that the market is facing. Many of you probably know and keep track of what's happening in Denver. It's one of the more the strongest performing markets in the country in terms of economic growth. We've created roughly 50,000 jobs each of the last few years for past a 3% job growth rate each of those 3 years. Unemployment now is 3.2%, and we've added about 40,000 people in terms of steady migration into this market each of the last 4 years. So a lot of new household formations. Wage growth is strong again. It's accelerated in the Denver metro area now between 4 and 5%. So it's very, very strong. We've got high resale volume, strong price appreciation that's pushing those move-up buyers into the new home market, particularly at the higher end. And there's a lot of new infrastructure that's taking place, new development that's taking place in the Denver economy, particularly our light rail expansion that's spurring a lot of mixed-use, high-density development, though a lot of it's tended to be toward the apartment market. And just like many markets around the country, we're faced with a lot of challenges. High land costs and development costs here in Denver. If you've ever tried to acquire water here in Denver, it's very expensive. The regulatory environment's really putting a lot of stress on the development community, get lots delivered in very quick order, because you can see the lots obviously are in high premium right now. And back to Mark's comments, we think we've reached this price ceiling. You know, we're at all-time highs for pricing, and we've actually seen a little bit of a drawback in our traffic counts from our weekly traffic and contracts report, particularly at the higher end of the market. So we sense that the consumer's pulling back just a little bit at those higher price points, but we still have very tight housing inventory, both on the resale side and the new home side, very tight lot supplies, tight trade labor. Construction defects are limiting the number of condos that we've been building. We'll probably wind up adding about 500 condos to the market this year. At the previous peak of the market, we added about 3,000 condos, just to give you a sense of the challenges this market is facing. So that concludes my comments, and I will now pass the slides on to Eric Allen, our Regional Director in Salt Lake.
Well, welcome everybody again. For those of you that may not know me, my name is Eric Allen, and again, I'm the Regional Director for the Salt Lake market. So I'm going to give you a kind of a quick synopsis of the greater Salt Lake market. I will say that there's quite a few similarities between Salt Lake market and the Denver market, but I'll challenge John a little bit as to who really has the best economy between the two markets. I think we're running head-to-head on that. So, but overall, you know, the greater Salt Lake market, you know, as far as our economy is concerned, again, one of the strongest in the nation. You know, over the last 12 months, we've created just over about almost 37,000 new jobs. And the economy is growing just over 3%. So we've seen a lot of immigration come into the market with a lot of these jobs. We've been touted as having the next Silicon Slopes in the greater Salt Lake market. And so that's created a really high demand for housing, of course. And so you can see over the last 12 months, the Salt Lake market, and again, when I talk about the Salt Lake market, this is basically the 7-county market that makes up the greater Salt Lake market. It's the 3 CBSAs. And we have started, you know, new home starts are running 10,442, as you can see there, and our starts production is up about 5% from last year. Closings are up 20% to just over 9,600, and you can see that gap between starts and closing are staying very tight, and that's really what we want to see. You know, builders have really been complaining that they just can't get enough labor. Similar, you know, it's a very similar scenario here in Salt Lake as it is the rest of the nation for the most part, as far as a labor shortage, and that's creating some big hurdles for builders and developers. We're running at about 58% of the peak when we started, almost 18,000 homes. So you know, when this market is normally a 12 to maybe 15,000 start market, so we still have some room to grow in this market before we feel that we start reaching that ceiling. You know, similar to what others have talked about as well is you know, pricing in the market continues to push forward and push upwards. You know, so that's creating more opportunity in the attached market and the townhome market. When we look at kind of the overall pricing, virtually everything under that $200, even up to about $250,000 in the Salt Lake market is primarily attached product, and for the most part it's townhomes. We're building a small amount of condos, but but that market has not come back yet. So townhomes continue to grow. There's a lot of builders getting into that arena and that product type as well. But when you look at kind of the way the pricing has gone in the Salt Lake market we've grown as far as our production is concerned. We have increased about 10% of our production under about $350,000, and then above $350,000, our production has increased about 28%. So much more production on the higher end side with a lot of in-migration. We're seeing a lot of money brought into the market, and Salt Lake has always been a pretty affordable market. And however, with land costs going up, that's driving those home prices. Obviously, labor is a part of that as well. Obviously, when we see low interest rates, we see more people spending more money on their houses because they can qualify for a larger amount and afford a larger payment. And so all those aspects are going into our pricing and what's going on here as well. As far as new home inventory is concerned, again, inventory here remains very tight. You can see a pretty rapid increase in our under construction inventory. Right now, currently, we've got almost 5,300 homes that are under construction. That under construction inventory has increased about 27% from last year and up another 7% from last quarter. But that finished vacant number, that finished vacant inventory is in kind of the Metrostudy term is our canary in the coal mine. That finished vacant number is the number we watch very, very closely. And as that finished inventory and that supply starts to increase, then that always triggers us to see a change in the market. We're started to get oversupplied at finished inventory. And when you look in this market, I mean, essentially, over the last almost 10 years, finished vacant inventory has just decreased quarter after quarter after quarter. We had a couple quarters in 14 where it kind of leveled off and increased, but our finished vacant inventory now is down to about a month's supply. And in the Salt Lake market, equilibrium for finished vacant inventory should be between 2 to 2.5 months. So we certainly have a lot of room to grow as far as our finished inventory is concerned. The problem is builders are spending all of their time on contracts. They put their labor when they get a new contract on a house rather than starting a new spec home. So builders are having a pretty difficult time. Capital has also been an issue there. Builders are just not able to get the capital that they used to build more spec homes. So a lot of dynamics that are happening there. But then our under construction is at 6.5 months, and then overall inventory is 8 months, and both of those are right there within pretty much within equilibrium as well. Finished inventory, again, when you look at each one of those price segments, that equilibrium, right there is 2 to 2.5 months is where our equilibrium should be. And essentially every single segment of the market is pretty well below equilibrium. The above $800,000, obviously is a little outside of equilibrium, but they're high-end homes, they're very high-end custom homes, and they take a lot longer to build. And so even that 3.7 months there doesn't concern me a whole lot, especially when that supply is decreased about 19% from last year. Again, as you go down that price scale, the lower you get, the lower the months of supply is. We know the demand is there, obviously, because we've seen that occur, and we know the buyers that are out there. A lot of first-time entry-level buyers that are in this market, but there's just not the product available for them. As far as our lot inventory is concerned, again, looking at that current lots that are on the ground right now, we've got just over 13,800 detached single-family lots in the market, and based on our current pace of absorption, that's a 21.7-month supply. As John mentioned earlier, equilibrium is in Salt Lake is between 18 to 24 months. So both detached lots and attached lots are either at the low end or below equilibrium. And so we've seen that lot supply diminish very quickly. Part of that is because land costs, builders and developers have walked away from a lot of deals just because they didn't pencil, they wouldn't work, and so we've had a harder time filling up that pipeline of lots to get those back out to the market, and with production increasing, that puts the squeeze on lots. We've delivered just about 9,000 lots to the Salt Lake market in the last 12 months, and of those 9,000 lots, the new 9,000 lots, we've already absorbed about half of those. So the lots that we're developing are good lots. They're A and B lots. They're lots the consumer wants. When you look at those lots in each one of those price segments, about 51% of our lot inventory are for homes above $400,000. So we have a lot of expensive lots. A lot of them that are on the Wasatch Back and the Park City, the Heber areas, some of which on the east side of the bench of Salt Lake City, and absorption on those lots is much slower. So that supply is obviously much higher. But when you look down into those home prices, between that $200,000 to $400,000, that lot supply there is extremely low. We're below equilibrium, and so we've got to see some more lots brought to market. Part of the reason we're not seeing a whole lot of new development also is the cities. I think a lot of markets are dealing with this as well. Impact fees are getting raised. Cities are kind of dragging their feet and taking longer to get projects through the entitlement process. And so all of these pressures are just creating a more difficult environment to develop lots. Looking, kind of at the Salt Lake pricing on new construction, you can see there our median price for a detached home is $349,000, and that's up 3% from last year. We're up, just over % from last quarter, and then the attached side there, you've got $228,000 there for a median price, up 2% from last year and last quarter. I expect, that we'll see pretty similar price increases over the next 12 months. I expect that we'll see another 1% to 2% increase over next year. The production is very high, demand is very strong right now in the market, and the deals that I see, the landowners that I see selling their land right now are not backing down on their pricing, and so I don't see our pricing slowing down a whole lot. We may see a quarter or two that it may flatten out a little bit, but certainly not expecting to see that drop. Obviously, as that detached price goes up, now we're really starting to see that push into the attached market, where that's now becoming kind of that entry level, kind of that first-time home buyer product. So, with that, again, Salt Lake is in a very good position right now. The fundamentals for the Salt Lake market are very well in place. As far as our economy is concerned, our housing market is very healthy. Again, it's fairly similar to what's going on everywhere else. We're just dealing with prices, and hopefully those will kind of start to mellow out a little bit, and we can see some more buyers kind of coming into the market and being able to afford a house. So with that, hopefully that gives you a little more insight on the Salt Lake market, and I'll turn the time over to Todd Britsch, and he can look at Seattle and Portland. Thank you.
For those of you who don't know me, my name is Todd Britsch, Regional Director here in the Pacific Northwest. Some of the data that I'm going to show you is going to look slightly different, as we are just at the end of integrating New Home Trends, my previous company, into the Metrostudy platform. And I'll run through and explain some of the differentials here. As far as our history goes back, these are contract sales, both attached and detached. You'll see here in 2015, we just peaked over 7,000 single-family home sales. We're going to jump a little bit higher than that moving in towards the end of 2016, and then where we're at in the cycle right now, we're just flattening out a little bit, even though all of our fundamentals are very strong, and I'll get into the reasons why. Starts versus single-family home sales. So you'll see here the detached quarterly sales. When we look at third quarter over third quarter, our sales are flat. Our starts are up 23%. Now this is primarily a catch-up process. If you'll notice here in the first quarter, we had significantly more sales than we did starts. So there's really about a 300 unit differential between the starts and contract sales data. So it's, like I said, it's a process of us catching up with the sales that have occurred. And much like Denver, Utah, labor shortage is a huge issue for our builders. The construction time frame historically has been roughly 120 days to maybe 150 days, and that time frame has extended out pretty significantly to 5 to 6 months at times now for the production builders even. This chart represents quarter-over-quarter sales, and then the percentage differential that you see here is a comparison of the previous year for that individual quarter. And you'll see the trend line. We are now, even though we're flattening out, this is just a leveling off inside of the marketplace. This is not by any stretch showing we are in a down cycle, because we are not. It's just that our percentage of growth, you can't continue up at that 5, 12, 10% growth per year. There does come a leveling point. Pricing has played a role in this. Inventory levels have played a role. And the finished inventory. So you've heard Eric and John talk about the months of finished inventory. We literally have weeks here. There's certain submarkets that have 1 week of vacant inventory. When you look at the entire Puget Sound, taking into consideration some of the outlying counties, that number is at a 1 month supply. When you look at the high demand areas, say the North Creek market area, which is north of Bellevue, south of Everett, anything within, say, 5 to 10 miles of a core employment area, the months of finished inventory is, as I stated, within a week. Median available price point over time. So I broke down each individual county so you can kind of see where the appreciation level has come in each county. King County, that you see in blue, in the fourth quarter of 2014 was sitting at about $575,000. It peaked last quarter at $750,000. We had a number of high-end projects that have since sold out, and now that median price point has dropped down to $650,000. Snohomish County, which is the red that you'll see, note that it was at about $585,000, and now that it's down to $450,000. This isn't that prices are depreciating. What this indicates is there's a submarket that is in borders the county line between King and Snohomish County. It's called the North Creek market area. It has historically been anywhere from 18 to 25% of all new construction home sales within the Puget Sound. There is only a 6-month supply of VDL left in that submarket and a 1-month supply of spec inventory. As far as the futures that particular submarket holds, it only holds 3% of the entire Puget Sound's future inventory. And the average size of the subdivisions that are going to be built out here within the next 2 years inside of that little submarket are about 10 lots. It's going to become an infill market. The amount of buildable lands in there is essentially gone. So what we're seeing now is a migration further north. And if you're familiar with the Puget Sound, what happens is once you get past the North Creek submarket, you enter into Everett. Well, there's no buildable lands in Everett, so then you have to jump forward 8 to 10 miles up into Lake Stevens, Marysville, and further north. So your commute time doubles. From if you live in that North Creek, it's an hour and a half into Bellevue on a bad day. From Marysville, you're talking 2.5 hours. So we're not seeing a lot of that migration northward. A lot of those buyers are funneling south down into Pierce County now, which you'll notice here, which is the green bar. So fourth quarter at about $315,000, now up to $487,000. This is primarily due to a master plan community that's being developed out in the Bonnie Lake area, which is about 45 minutes south of Seattle. And Shea Homes and Richmond American are kind of some of the driving factors in creating that higher price points. Well, let me talk about inventories here. So you'll see the bolded numbers. King County. An equilibrium for me is a 20-month supply of vacant delivered lots, and then a 4-month supply of spec inventory. And that's, for me, it's unsold spec inventory, and that's any home that's under construction and or complete. And you'll notice that King County has just under 15-month supply of vacant delivered lots, and only a 3.6-month supply of spec inventory. You jump over here to Snohomish County, it's a 10-month supply of finished lots, and that should be at 20 months supply. And then only a 2.4-month supply of homes under construction and or complete. And as I stated, you look at this number here in Snohomish County, and we're down to literally just weeks of finished supply. Pierce County, that has the vast majority of the vacant lot supply, comes in because it's got the Tahali master plan community. That's where the vast majority of that inventory comes from. And then you'll notice each one of the regions outside of Thurston County have very low levels of spec inventory. When I start looking at the future lot inventory, I want to see what happens with us keeping pace. Are we recording as many lots as we are selling inside of the Puget Sound? And you'll notice from 2009, we've extracted almost 17,000 lots out of the marketplace. What this represents is the number of sales that have occurred minus the number of recorded lots. And every year we've seen a negative number. And then through 2016, the third quarter, we've already subtracted 2,000 lots from the marketplace that we have not replaced. In migration, this is probably the best news that you can have when it comes to the Puget Sound region. This is the net number of driver's licenses that have come into the Puget Sound. And since 2012, we've been averaging about 10,000 new individuals into the state. And of that, about 65% have stuck around inside of the central Puget Sound region. Job growth within the core areas is remaining very strong. If you start getting into the outlying counties, it's weakening just a little bit. The in-migration, as stated here, is about 10,000 per month. Inventory in King and Snohomish counties are critically low. And the market is flattening in regards to contract sales. And what I'm seeing is that over the next 12 to 18 months, we should start to see land and home prices do the same. Okay, so let me touch base on Portland real quick. Portland's in a little bit different scenario. They're about a year ahead of where the Seattle market is right now, and they don't have the large companies that can support the high levels of job growth that the Puget Sound region has had. So we're going to see a flattening and then a decreasing in sales over the next couple of years. 2015 was by far our best year that we've seen inside of the Portland metro region for quite some time. Single-family home sales are down 21%, and single-family home starts are up 11%. And if you'll notice here, for the last 5 quarters, we have oversupplied on starts versus sales. So what we've seen consequently is our months of finished inventory climb up to about a 1.2 or 1.5 month supply, and then months of inventory under construction has climbed as well. Growth management has put a real stranglehold on land inventories over the last couple of years. Consequently, land prices have skyrocketed, thus making home prices skyrocket as well. So you'll notice in the first quarter of 2015, the median available price in a home in Washington County was $450. Now it's $561. Clackamas County was about $445. Now it's $489. Clark County is where it holds about 50% of the land that's in the pipeline and 50% of the currently selling inventory as well. They're really the only county that has seen any kind of stabilization in price point. $350 to $390 is not that large of a jump considering the amount of growth that the region's seen in the last couple of years. Here's our inventory levels. So these, right now, they're not at alarming numbers by any stretch of the imagination. However, when I go back and I look at some of the presentations I've done in the last few quarters, these numbers were at 1.8 to 2.5. So that spec level inventory is climbing. The equilibrium for me is about a 12-month supply of vacant delivered lots. And right now, Clackamas is at 9, Clark at 12, Multnomah 14, and Washington at 14. The reason that number differential is so significant between Seattle and Portland is the platting process. In Seattle, it's 3 to 4 years. In Portland, it's 1 to 2 years to take a raw piece of dirt all the way through entitlement to recorded finished lots. Portland has the exact same issue. You figure it's about half the size of Seattle in regards to its demand. And the number of lots that we've extracted since 2009 out of the Portland market is almost 8,000. And you'll notice in 2016, we're sitting at 1,800 lots already that we've extracted from the market and not replaced. So we're in desperate need of VDLs to kind of, again, create that equilibrium and balance price points out. Annual job growth within the Portland metro region was about 22,000, so it appears very strong. However, when we look at the last couple of months, going back to the end of the first quarter, we're only adding about 200 jobs a month. So there, we are seeing a slowing in that job growth. The sharp decline of 3%, or in the third quarter, near 21% for single-family home sales, I think we're going to continue to see that moving into the fourth quarter. It'll level off a little bit and come back up to about 7-8% on a negative scale moving into the first quarter of next year. And it's again because of the amount of job growth that they had seen in 2012 to 2015. VDL and unsold spec inventory have risen to levels that should create a label or a stable pricing market for me. However, I don't think that's going to happen. And I think that'll end up following by about 18 months. For my builders out there, I'm warning them, you've got to be very cautious in regards to any land acquisition that you're doing at this point, because buyers may not be able to qualify if you're calculating in any appreciation into the projects. The tech sector is where the vast majority of that growth. So when we go back and we look at the boom that we had in 2015 in the Portland metro market, it came from a number of companies that came up from the Silicon Valley and moved into the Portland metro region. The tech sector grew by 85% to 13,000 jobs. Now, those companies are here, they're stable. While they may still be hiring, the vast in-migration of those tech jobs has come to an end. But still a very strong sector within the economy and growing well. So with that, I will hand it off to Justin.
Thank you, Todd. So we were slated for 45 minutes. We've gone the full 60. We've got about 4 or 5 questions for the Q&A. So what I'm going to do is I'll have our experts reply to those questions via email. So thank you very much for attending today. Thank you, Mark, John, Eric, and Todd for your insights and expertise. If any additional questions do come up throughout the day today or later this week, feel free to send them to our webinar organizer, Heather Knudsen, at hknutson@metrostudy.com, or if you prefer, to my attention at jcaron@metrostudy.com. You are going to be receiving a follow-up email with a link to the webcast recording for future viewing from Heather. If you're looking for more information on how to put Metrostudy data and market intelligence to work for your business, please visit us at www.metrostudy.com. We'll be hosting these web sessions quarterly going forward, and ask that you save the date of our next event, December 1st at 2 p.m. Eastern Time. We'll be debuting our Consumer Insights webcast series with a look into the millennial buyer. We hope that you can join us. Enjoy the rest of your week.